Thank you. All right, the markets have remained steady on the final day of the trading session. We have seen that Nifty has logged its fourth straight weekly gains. And with that, the markets have remained quite buoyant throughout the trading session from the past 3 days itself. But yes, let's go across to my second guest of the show to understand how the market looks like for the long term. Joining me is market expert Sunil Subramaniam. Sunil sir, good afternoon. So good to have you back. And, a good day to chat because you can see that Nifty has logged its fourth weekly gain now. Brent is under control. Brent is also under control. So how is the market setup looking like as we head to the earnings season next week?
Well, I think the market setup looks to be still in a consolidating phase. If you notice that when the ceasefire announcement came, on that day, the markets rallied. I think large caps rallied 2%, micro caps rallied 4%. The rest were in between. But after that, you see, the market has kind of stepped into a range of a 0.5% plus, 0.5% minus. And only thing is that the smaller segment has done better than the larger caps. And one of the main reasons is that we get to see the return of the FIIs. Their selling has dramatically reduced after the announcement of the peace process, but they're yet to turn major buyers. So hence it keeps the large caps under pressure. DIs have been buying fairly supportively, but they titrate their buying to FIS selling. So if you notice very closely, the days that the FIS sell a lot, DIs buy a lot. The days FIs don't sell a lot, they also reduce it. And in fact, when the FIs turn net buyers of 100, 200 crores on some days, you see DIs are totally inactive. So clearly they are taking a view that when the FIs sell, good quality stocks come down in price, we'll go and accumulate. Otherwise, they are waiting for the earnings season to play out. What has actually driven the market is the broader market, the small cap, micro cap indices. Even for the week, if you see, or for the month, they have been the outperformers. And here it's the broader retail or the individual segment. I wouldn't call it just retail. You have HNIs, you have retail, you have prop books, you have family offices, you have the portfolio management services. So these players have been the ones who have been more bullish, especially after the peace deal. And hence there's a strong rally in the bottom end of the market. And advanced decline ratios are also reflecting that generally they've been in favor of advances. So I expect this particular methodology of the market that the large caps would remain in a very range-bound session till the earnings season actually shows some guidance, as well as you will see the broader caps probably getting a bit of support because of the fact of two things. One is FIs are absent from there, so it is the local flavor to that, and a lot of the news around the monsoon is still going to play a part in terms of the rate sensitive sectors, because RBI policy will be dependent on now food inflation. Now that imported inflation is not so much of a concern, it is the food inflation which is next on RBI's mind, and hence equity stock market actions would depend critically on that.
Okay, got it. Sunil sir, but how do you feel about the rupee now? Once again, back above 95 against the US dollar. Do you think the RBI measures were enough, or do we have to deal with 94 to 95 becoming the new normal now?
Yes, I think 94 to 95 will be the normal, because see, we've already seen about 65,000 crores of FII debt flows come in. That's also helped the rupee to be stable. We've also seen that the NRI has yet to pick up on the FCNRB, but there's time till September 30th because banks are offering upwards of 6 to 7% for FCNRB holders, which is very attractive compared to the fact that the US Treasury is at 4.5%. So definitely till September 30th, you could see some flows, and estimates are between $40 to $50 billion of flows. But that's just the, whatever I would say, 1 month of RBI action, right? So rupee would, I think, definitely not strengthen much beyond 94 down. It'll be in the band. But if you look at the 1 year forward premium, they are ruling at about 275 to 280 basis points. That is depreciation of the rupee. Whereas the interest rate differential between the two countries is only about 2.3. So there's still a 50 basis points devaluation pressure on the rupee. So I would say that from a 6 months, 1 year perspective, the rupee is clearly in a depreciating trend. These short-term actions by RBI are keeping the spot rupee down. But our outlook for the rupee, I would say, is still for it to be at about 97, 97.5 at the end of a year.
Okay, all right. Okay, 97.5 is you're expecting by the end of the year.
Yes, end of 1 year. not end of the calendar year, 1 year
Okay.
from today.
Okay, got it, got it. All right, Sunil sir, we saw that the last quarter belonged to metals, autos, and energy plays. Which segment do you think would be a best play ahead of the first quarter numbers?
Metals, auto, and energy, you have picked the three most difficult sectors. Why do I say that? You see, metals are definitely something that, with the global thing, I think China's growth rate is a bit of a concern. They're not out there buying. In fact, that's also contributing to the oil price falling sharper than anticipated earlier. So I think metals impact will be there, and that's why it's been underperforming. On the case of the energy sector, clearly, if you look at it between the producers and the refiners, I'm not confident about either of them. The producers, because obviously dropping oil prices is not good for a producer, right? That's a clear case. But the refiners also, while the dropping oil prices is positive for their refining margins, the fact is that the under recovery from this year's not being passing on to the customers. And Mr. Hardeep Suri yesterday mentioned that the number is about 2.1 lakh crore. So clearly, government has passed on the fiscal deficit pressure on to the oil marketing companies. So to that extent, their earnings are going to be under pressure. So I wouldn't even bet on the energy sector, not on the metal. Auto is an interesting play because auto sales numbers, top line numbers have come in pretty strongly, as you saw, except for I think Hyundai, because there was a fire in the factory, was not so great, and Hero Motor I think was not great. Apart from that, the rest of the auto companies, whether whichever segment, private passenger cars or two wheelers or commercial vehicles, showed pretty good top line growth. The key thing is that the oil price impact will be felt in this quarter's results because last quarter we didn't see the impact because older raw materials which they had bought were getting used through the quarter till March end. But in this quarter, the high oil prices in March, April, and May are going to hit their bottom lines, and these are all heavily dependent on oil crude. First, in terms of the petrol part of it is a different issue, but paints, tires, a lot of things need petrochemical inputs, right? So their costs are definitely going to be quite high in this quarter. So auto margins are a key thing to watch out for. So this top line growth may not be reflected in equal amount of EPS or a bottom line growth. So to that extent, the Q1 results may not be great, but I would say still that auto is something that I would look forward to accumulating as a buy on dips. The reason for that, we know the past is history, right? This is the cost, the poison they've absorbed in terms of the high cost. But now, from going on with a $72 crude, and I read a report of Citi that they are predicting a $60 crude. So, if you go forward in terms of the oil prices, the pressure should ease. And with a festival season coming up, when auto sales again do to pick up, right, it should be good. Except monsoon again to replicate, tractor demand will be dependent on monsoons to some extent. So I would say that auto could be a buy on dips, even if the results come bad and there is some correction in the stock prices. It's something that I would look as an accumulation.
Okay, got it, got it. So, sir, a lot of banking companies, they have reported their provisional figures. Does the slower deposit growth worry you?
I think the slower deposit growth will not worry as long as the credit demand is good enough, which means that the banks will obviously find alternative means of financing, certificates of deposits and overseas borrowing, masala bonds, they'll find, but they are higher cost than deposits. So the higher cost of those, if they can be passed on to borrowers. So it all depends on the lending side. Now, lending side is growing quite healthily. So I expect that their NIMs would be under slight pressure, but they should be able to pass on because when there's credit growth, especially if you see, oil price rise means working capital needs have gone up. So there has been heavy borrowing there. Retail loans, you saw RBI's report, retail loans have been strongly going up. Personal loans, gold loans, all have been going up. So as long as credit demand is good, the cost of higher mobilization of funds apart from deposits should get managed and passed on. So NIM pressure could be less. Right? It's only if I see that deposit growth is also slowing and credit growth is also slowing that there will be a challenge on the NIM. So I'm not so worried about the challenges they're facing in deposit mobilization. Well, you have the stock market to thank for that, right? People's SIP books continue to be strong. So I think that's where people are putting their money into SIPs rather than into CASA with the banks.
Okay, got it. So, sir, what about the NBFC companies? I mean, last quarter, they were the ones who actually outperformed from the financial segment. Today also we have seen some good numbers that came in from Bajaj Finance, and that's the result why all of these NBFC stocks were also up. Going ahead, how do you feel about the NBFC space, and can they continue to their outperformance?
I think so, because I just mentioned that personal loans are growing pretty fast.
Right.
NBFCs lead in that. Gold loans are growing pretty fast. NBFCs lead in that. So this kind of a lending is that where the issues will be is that if there's a monsoon weakness, right? Then the sowing and the fertilizer, if there's not that much demand from the agri side, but anyway, NBFCs are not great in agri rural lending, so that may not impact them that much. So I do think that NBFCs are a good play because they were anyway not dependent on low cost deposits. They were either dependent on higher cost deposits than banks. And so even in this period, because banks are hesitant to raise the deposit rates too much, so you have NBFCs are already giving a 100, 150 pips delta to retail customers in deposits, right? NBFC rates. So they won't suffer so much in terms of raising deposits because they're offering higher rates than banks. At the same time, they're also depending on borrowing from banks to finance their book. So they always operate on a higher borrowing cost and compensated by a higher lending. So since the retail lending is going to be driving stuff in this quarter, I do expect NBFCs to, by and large, be in a decent performance with not too much performance on names. And even there, I think the NPA levels are not yet a cause for worry.
Okay, got it, got it. But yes, Sunil, let's talk about the Nifty IT index. It's been a wild week for this particular sector. Past 2 days have definitely been quite good because they've been rejoicing. They're seeing a bit of a rebound. But still, the stocks still remain below their 200-day moving averages. Do you think that, does that suggest further downside, or do you think these oversold levels can actually be attractive?
Well, first of all, IT is no longer a growth sector. IT companies are all value plays at this point in time. So, to that extent, if you see the correction and the bounce back, I see that as a value play coming in, that people are allocating it more from a value perspective. I think because of the AI threat and the risk, I don't see IT rushing into become a growth sector. So, that's number one. Second point of view is that the reason for this sudden change of heart is the extreme correction has led to a little bit of domestic institutional investors feeling there's value. Second, there was this report by Guggenheim, I'm sure you would have seen this, which said that they feel that in the US software companies, the whole market correction has overdone. So they say that the models which are projecting the prices for these software companies like Salesforce and the like are actually taking it as if these earnings are going to fall off a cliff. Whereas the reality is that there is a slowdown, there is a challenge because of AI, but they're not going to disappear. So they have upped the price targets for a number of these software companies in the US by as much as 25 to 40%. So I think it's that thing spilling over here on the IT sector saying, oh, if that's the case for the US based software companies, then Indian companies are in the same boat. So that's a positive sentiment driving these. So whatever said and done, we have to wait for the second week of July for the bellwethers to report their results and their guidance, because it's that which is important. So till the numbers actually come out for Indians, you're now billing on sentiment. You're looking at it as a value correction and hence a chance to buy. But there is no clear signal that their growth for the future, how far it's impacted, how are they going to manage. Satisfactory answers have to come from the IT bellwether companies in terms of the strategy. And so I would say do not take any call today until the earnings come out. Once the earnings comes out and the earnings calls are done and the guidance is done, we can then take a call on IT. At this point, it's a very tactical play. And those who want to kind of look at your 200-day moving averages and take a call, but with good stop losses and book profit levels, they can venture into this. But as a growth-oriented buy, I would still say IT is not there. Some people want to allocate more from a value perspective. Yes, there is definitely value there. Margin of safety has gone up. They're good dividend yield companies. So to that extent, if you want to look at it purely as a value play, you can probably start accumulating it. But like I said, for taking a call, I'd rather wait for the earnings season of the bellwethers to come through and then see what is the lay of the land in terms of is US discretionary spending coming down? Are people taking on projects but not giving those small incremental high value, high margin projects in the middle, which is the news coming from the US. So I think a lot of things, I would rather wait for the earnings of the bigger IT companies to come out, study them, and then take a medium-term call on IT.
Okay, got it. But what do you make of the sentiment around the global AI trade? Do you think it's weakening after, Palantir CEO also criticized the OpenAI and they're saying that their token-based pricing model kind of drains out the enterprise funds. Do you think the AI trade could be peaking from here on?
I don't think so. I think the AI trade is it's not a bubble. These companies are actually showing very good growth rates, and there's a huge amount of AI spending. The concern around AI, I would say, is more the fact that the biggies like Google and Microsoft and Apple and everybody are spending a huge amount of capex around AI, and whether the return on investment that justifies it. That's the more of a concern rather than the AI itself. The AI is, I think, a new industrial revolution, long way to go, and the reason that we are feeling is because the markets where the AI is being played, it's a very polarized markets. You have two companies in Korea, two companies in Taiwan, few companies in Japan, which are driving the entire stock market up. They're very polarized, right? So from that polarization perspective, there is a risk because there's too much dependence on just a few companies. But I think AI as a revolution is here to stay, and it is definitely going to be. You'll have to diversify and play because not everybody will be a winner who's investing in the AI capex and all of that. But I don't think that it's a bubble that's going to correct in a hurry. So I'm not of that view. We saw a couple of days in the previous weeks where there was a correction. Yesterday, the Korean market, there was a correction. But today, already Korea has bounced back 6%, I saw. So I think there will be more. And then that's also because of, I think, high degree of retail lending, margin trading in Korea, which led to a panic selling. Overall, I think that the AI story still has the charm for foreign institutional investors. They're still allocating more there. Individual ETF flows also, if you see, are still oriented towards AI. So I'm not sure that there is a big bubble burst waiting to happen quickly. There will be these days of corrections and all of that will happen. But I still, the AI story has still a longer way to go. And hence, to that extent, FII money still continues to chase the AI. That's why if you see, the Brent crude correction hasn't seen a huge flood of FII money flowing into India because they are still treating AI growth in these countries which have AI in a big play at much higher rates, about 20 to 30, 40% compared to the growth rates in India. So while on occasionally on days you'll get some correction triggered by some news, right? It's not that it's not like the dot-com bubble or anything where it's gone crazy in terms of valuations. Yes, they are high valuations, but justified by the high growth so far demonstrated on the ground. It's not way out of whack compared to earlier bus that happened. So I'm still saying that there will be few days of corrections, but it's not like the AI bubble. I don't think there's a bubble, first of all. So I don't think that there will be days of corrections. That's what it is.
Okay, got it, got it. So you mentioned that banks are something that you can look at. In autos, you remain cautiously optimistic. Any other sectors that can be worth looking at before we begin with the Q1 earnings?
So I would say that green energy, alternative energy is probably going to be a big push, not just in India, but across the world. So I bring in alternative energy for one is, of course, there's a thrust. You saw the Delhi related actions taken. So the EVs and those are probably definitely India has suffered the pain of this war without being one of the actual parties in the war. So clearly, as a country, we don't want to be in that same situation. We are going to be reducing whether it's through ethanol blending or whatever. So where I'm coming from is there are a lot of green energy the capex to build the green energy. That's my focus. So I believe that capital goods, and it's not just in India, a lot of damage which has taken place in the Gulf, the rebuilding, I'm sure those order books will come to the big Indian infrastructure majors. So to me, the rebuilding post-war and the rebuilding and the building up of fresh green capex, green energy alternatives are going to be the next. So capital goods as a cycle, I believe, is set for a big boom in the coming months. And I would say that it's a good time to start accumulating that. That's a medium term, both from an export oriented and from a domestic capex perspective.
Okay, got it. Got it. All right, just one last question before I let you go, Sunil sir. We are seeing a sharp reversal in months in both gold and silver ETFs in the month of June after months of outflows. Do you think this is primarily just a bargain buying after the correction, or do you see that the dollar strengthening side by side could actually pose a key headwind going ahead?
So I think that if you look very near term, all that you say is right. But just put yourself 1 month down the road. The inflation print in the US is going to come down because Brent crude and West Texas light crude both have come off, what, 30% in a month now. So the next inflation prints in the US will be much softer. So that will set the base, first of all, to rule out a rate hike in the rest of the year from the Fed and maybe talks of a rate cut. So that will immediately lead to a dollar weakening, not a dollar strengthening, and US interest rates trending down. So right now, what I'm saying is doesn't look likely, but just put yourself a month later, right? This oil, in fact, is definitely going to see in the inflation. So from that point of view, with a weakening dollar and a lower interest rate cycle in the US, with lower inflation, gold and silver will again see a good bounce back because central bank and sovereign wealth fund buying of gold as part of your de-dollarization process is not stopping, right? In fact, except for a few countries like Turkey booking profits in gold because they had to meet with the high inflation due to crude. That's very tactical. There are still, and in China is still accumulating gold at the ground level, and if you look at the Swiss refiners, that's also a thing. So I think gold demand from a fundamental countries as an alternative currency is going to continue. Plus, a weakening dollar will give it a boost. So to that extent, I believe that this correction that took place in gold is being seen by investors as a buying opportunity, and I support it. But the thing is not to expect the kind of rallies in gold that happened last year, but definitely a healthy double-digit return from the precious metal pack over the next year, I think is reasonably doable. So I expect that buying support for the gold to continue.
Okay, got it, got it. All right, so it's a lovely conversation like always, but with that we have to let you go. But thank you for connecting with us and appreciate your time.
Thanks a lot.
All right, so markets have remained quite steady so far this week, and of course this week itself we have seen both the benchmark indices have logged its fourth weekly gains. Now, whether or not this momentum sustains into the next week when we start the India Inc.'s earnings season with TCS reporting its results on July 9th is something that we'll be watching out for. But for the time being, that's all we have for this edition of Closing Bell. It's a wrap from me, and for more news updates, do stay tuned to Money Control.